All right, so welcome to chapter 16, where we'll continue our conversation about budgets, but specifically around how they help us control expenses and assign responsibility. So in this chapter, we will look at a few learning objectives. We'll first of all describe what this means, being budgetary control and static budgets. We'll look at what flexible budgets may look like and how helpful or not helpful they may be. And then we'll look at responsibility accounting. So typically you have what we call departments or cost centers, sometimes known as profit centers as well. It could be by product, it could be by division, commercial versus private or personal, things like that. And then about evaluating performance in various investment centers. So looking at budgetary controls, when you use budgets to help control your operations, they're known as such. So what they do is you've created a budget for a company, for a division, for a product line, whatever that might be, and you use that budget to compare against your actual results. So you look at what your planned objectives are compared to your actuals. Management then can then provide feedback based on how are you performing? Are you spending too much? Are you spending maybe too little, which is probably no such thing. Are you selling enough? Are you not selling enough? And budget reports are typically prepared as frequently as needed. I would say at least on a monthly basis for internal purposes, but depending on the size of the operation or the organization, it could be weekly, daily, whatever that might mean. And then management can use those reports to discuss and review any differences between actual and planned results. So if you're dramatically under production or under sales or over budget, you can look at those variances, hopefully make course corrections once you identify what's the cause, and get back to a budget or below budget situation before the end of the year. So what it looks like visually then is you have the developed budget process standpoint, like in chapter 15. Chapter 16 is focus where we analyze the differences between actual and budget. We will then, take corrective action. We will modify our future plans, which will then feed the next cycle of budgets. So over a period of time, there is this loop in the budget and budgetary control processes. Excuse me. So in the reporting system for budgetary control, you typically have a name on the report. So is it the manufacturing overhead report? Is it the product 100 or product 200 report, whatever that might be for a period of time? Is it for a month? Is it for a week? Is it for a quarter? So that talks about the frequency of the report. What's the purpose? So is it for internal management purpose? Is it for sales? Is it for production support? Is it for the purchasing department to identify where maybe they're buying too much, too soon, too fast, paying too much? And who are the recipients? Is it the division manager? Is it the board of directors, or is it somewhere in between? So a little reporting system of what it may look like in sales. You probably want a weekly sales reports. Again, depends on the size of the organization, but on a weekly basis, it gives you more time to respond. And the purpose of this is to determine whether your sales goals are met. Who typically looks at this would be both your sales manager and your top management. Your labor report may also be done on a weekly basis, especially when you have a larger workforce. Are you controlling your costs, indirect or direct labor costs? And your production folks would typically be interested in it. A scrap report and how much waste are you producing? And this, in this example, we're suggesting on a daily basis, because then hopefully you can correct it. Maybe you're ordering the wrong size of supply or raw materials, so you have too much scrap. And that production manager can typically look at that as well. Overhead costs are typically done monthly, help you control those overhead costs. Selling expenses are typically monthly. And your income statement is monthly or quarterly. And then obviously you would have an annual report as well. So a quick question then, budgetary control involves all but the following. So we had that little visual earlier. Does it include modifying future plans, analyzing differences, using static budgets, or determining differences between actual and planned results? So I would say A, B, and D are true, making C the one that is not included. So static budgets are not part of budgetary control. Some will define what a static budget is. A static budget is a projection of budget data at a certain specific level of activity. So for example, in chapter 15, we talked about a certain level of production, period, 158,000 units. And so it assumes we will produce 158,000 units. So static budget is used at a specific level of activity and compares actual results with the budget data at that activity level used in the master budget. So a little example here. We've got the budget and actual sales data for this right ride product in quarters 1 and 2 of 2022. So we had a budget of $180,000 in the first quarter, $210,000 in the second quarter, and you can see our actuals in both cases are slightly below. So a total difference is $11,500. So if we look at our little sales budget report, say for the first quarter, you would demonstrate that the $179,000 is a $1,000 unfavorable variance to the budgeted sales income. For the second quarter, if we do the same kind of picture, we would have a second quarter will be $10,500 unfavorable. So our year-to-date budget to actual is an $11,500 unfavorable position for the right ride product line for the first 2 quarters or 6 months ended June 30th, 2022. Now this is focusing on a static budget, which means we're not looking at volumes, we're just looking at dollars and cents. So static budgets are very appropriate when evaluating a manager's effectiveness in controlling costs when the activity level approximates the master budget. So if we said we were going to produce 150,000 units and we produced 149 or 151, that's close enough and it's reasonable. It's appropriate for fixed costs. So when we know what our rent is, we know what our insurance is, things like that. But it's not always appropriate for variable costs. So as our variable costs change based on the production volumes, it doesn't change in the static budget scenario. So it's not appropriate in those situations. Oops, I went the wrong way, I apologize. So a quick question then, a static budget is useful in controlling costs when cost behavior is mixed, fixed, variable, or linear. And we were just talking about it's best when cost behavior is fixed. So let's look at a little example then. We'll apply a static budget report. So we have this company, they expect to produce 5,000 units during the month. Budgeted variable manufacturing costs per unit are $6 for direct materials, $15 direct labor, overhead at $24. Monthly budgeted fixed manufacturing overhead are $10,000 for depreciation, $5,000 for supervision. And in the current month, Lawler actually produced 5,500 units and incurred the following costs. Direct at $33,900, materials, labor $74,200, overhead $125, depreciation and supervision. And we're asked to prepare a static budget report. So we have this little visual here. Our budget then was based on 5,000 units times those variable costs, 6, 15, and 24. We had total variable costs of 225,000. We had our fixed costs of 10 and 5, so we had total costs of $240,000. On the actual side, we produced 5,500 units, but we're told what the total spend was on materials, labor, and overhead. So we're only over by $3,600 in total. Our labor was actually favorable, and we produced more units. And overall bottom line, we are $3,600 unfavorable. So that's a static budget. Simple, to the point, and done. Let's move on to flexible budgets then, because very often as your production volumes change, you need to adjust some of your budget expectations. So back in this previous slide, for example, if you know your direct materials should be $6 per unit, but you produce more units, flexible budgets look at, well, if our units increase, our direct materials should increase accordingly, or if they decrease, it should decrease accordingly. So you don't always look at the total dollars only. And that's what we'll talk about in this next learning objective. So flexible budget looks at budget data for various levels of activities. It's basically, you could look at a series of static budgets. We have a static budget for 5,000 units, for 5,001 units, for 6,000 units, etc. And it's more useful because it's adaptable to our changing operating conditions. And we can prepare it for each type of budget in the master budget. So whether it's sales, production, overhead, selling and admin, whatever it might be, you can use flexible budgets in each type. So a little visual here, we have Bartoon Robotics. They have a static overhead budget. And we have our units at 10,000, and we have a bunch of budgeted costs on screen here: indirect materials, labor, utilities, depreciation, taxes, and supervision, for a total of 1.1 million. So then let's assume that 12,000 units were actually produced instead of 10,000, and we have our costs that we actually incurred. So at first glance, you think, hey, we're way over budget, $132,000. But perhaps it may or may not be an appropriate comment because we did produce 2,000 or 20% more units. So in this case, we were over budget in 3 of the 6 overhead costs. Our unfavorable was 132,000 or 12% over budget. Our budget data for 10,000 units is not really relevant in this case, because it's meaningless to look at 10,000 unit budget versus a 12,000 unit actual production. So the variable cost component should increase with production. So now, if we look at the variable costs, analyzing the budget data for 10,000 units, we arrive at the following per unit results. So if we go back to the slide before, we had indirect material of 250,000, labor 260, and utility of 190, 250, 260, 190. If you divide that by the 10,000 units that was initially budget, you get $25 per, $26 per, and $19 per. But instead of 10,000 units, we need to multiply to get our budget cost at 12,000 units. So therefore, our total budgeted variable cost should be $840,000 for 12,000 units of production. So now we can adjust our flexible budget components. So we now have 12,000 production units times our per unit costs for a variable cost of $840. Our fixed costs do not change. So our total budget should have been actually 1.24 million instead of, I think it was 1.1. So we had 20% more units, all of our variable costs increase. Comparing our actual then, which did not change from that prior slide, we can then see we're actually $8,000 favorable in all of our variable costs. So actually we're under budget. And that's true for overall. So you can see how a flexible budget is more conducive to actually analyzing and understanding your true costs of building and supporting your business. So when you develop a flexible budget, there's a number of steps you need to take. First of all, you need to identify your activity index. And what's your range of activity? Do you think you'll produce 8, 10, 11, 12, 20,000 units? And that's your range of activity. Then you need to understand what is a variable cost. And you need to determine the budgeted variable cost per unit of activity. So not just the total budget. You then identify fixed costs and determine the budgeted amount for each cost. And then you can prepare a budget for selected increments of activity within the relevant range. So say your range was 8 to 12,000, maybe you'll produce a budget for 8, 9, 10, 11, and 12,000 units. Just have an idea of what those budget figures look like. So a little example here, we have Fox companies. They use a flexible budget for monthly comparison. And the master budget for the year ending December 31st, 2022 shows the expected annual operating costs as below: variable costs for 120,000 direct labor hours, variable of 480, and fixed of 360. First of all, we need to identify the activity index and the relevant range of activity. And in this case, we're going to assume it's direct labor hours because that's the only stat that we were given in the previous slide. And we'll assume the relevant range is between 8,000 and 12,000. So up here, okay, because this is annual, and we're saying per month. So 10,000 on average, and we're going to have a range of 8 to 12. Then we need to identify the variable cost and determine the budgeted variable cost per unit. So we'll take our 3 variable items, our total cost divided by the total estimated annual hours, gives us an average overall across indirect materials, labor, and our utilities of $4 variable cost per direct labor hour. Next, we need to identify the fixed cost and determine a budgeted amount for each cost. And we were told we have depreciation, supervision, and property taxes, 15, 10, and 5. So now we can prepare perhaps a flexible budget for a monthly flexible budget for this department. So let's assume that we'll say the range is between 8 and 12. So we've set up a table for 8, 9, 10, 11, and 12,000 units. Our variable costs, you can see here, do increase with increased volume of labor hours. Our fixed costs are just that, 30,000 a month, no matter what happens. So our total costs in our range are between $62,000 per month and $78,000 per month, depending on the actual labor hours consumed. So now the cost equation for total budget costs, we need to look at the budgeted costs at whatever level of activity we determine is appropriate, plus the fixed costs would equal our total budgeted costs. So for example, at 9,000 direct labor hours, our total budgeted costs are 66,000, 30,000 in fixed, plus the $4 per direct labor hour times the 9,000. 36,000 plus 30 is 66,000. Similarly, if we only had 8,622 direct labor hours, our total budgeted cost would be the 30,000 fixed, plus the $4 per labor hour times the 8,622 would give us a total of 64,488. So a little data graphic on our flexible budget. Obviously, there'll be our fixed cost is where our starting point is on our y-axis, in this case, 30,000. And then it's a straight line because our variable costs are per unit. So our total budgeted costs will go up on this red line in this example. So you can see how it increases with the increase in direct labor hours. So flexible budget reports then use a couple of different things. It's an internal report, first of all, and it has 2 sections. It has production data, so it might have direct labor hours like the example we're looking at. It could have total number of widgets or items produced. And it has our cost data for variable and fixed costs. And these reports are always used to evaluate a manager's performance. So is that manager managing costs appropriately within budget per unit? And part of their salary or compensation might be dependent upon it. So now let's assume a month passes. So we have some actual information. So we have direct labor hours for the month of January, our budget level at 9,000 with an actual 9,000 delivered. And in this case, we were unfavorable in direct materials, favorable in labor, unfavorable in utilities. Our fixed costs are fixed. So we were favorable overall by $400 at the level of 9,000 hours. So question then, at the 9,000 hours, the flexible budget for indirect materials is 27. If 28,000 of indirect materials costs are incurred, the flexible budget report should show the following difference for indirect materials. Now, that's important here is you have to look at 9,200 direct labor hours, not 9,000 hours. So in this case, 27,000 flexible budget for 9,000 direct labor hours is $3 per direct labor hour. So if we take $3 times 9,200, our budget then would be $27,600, but we incurred $28,000. So that tells me we were $400 unfavorable. Again, pay attention to these figures. All right, so let's do another example here. We have Strassel Company. We have a flexible budget graph. So we're given a fixed cost across the bottom of the screen here. And we have our variable costs going up to the right. The total budgeted cost line is 186,000 at an activity level of 50. So at 50, we're at 186 up here. And compute total budgeted costs for 30,000 direct labor hours. So we want to know what it is here. So you could cheat and just say, it's about 120,000, but we can actually do the math. So first of all, we need to compute the total budgeted cost at 30,000 direct labor hours. So using the graph, fixed costs are 36,000. Okay, as we're told here, 36,000. And variable costs are $3 per direct labor hour. So we were told it's 186 less the fixed cost divided by the 50,000 hours would be $3 per direct labor hour. Therefore, if we reduce our direct labor hours to 30,000 hours times the $3 per hour plus the fixed at 36,000, we get our total budgeted cost at 126. So if we look back at our graph, seems about right, somewhere in here, a little off scale, but the math makes sense. $3 per direct labor hour. Moving on to section 3 then, we want to apply responsibility accounting now. So we're going to take these reports and look at our cost or profit centers. And what does that mean? So we look at our costs and associated revenues based on what manager or which manager makes decisions about those items. So it could be if you have a manager that's responsible for sales and expenses, they might get both pieces. But if you have a manager that's only responsible for expenses, then maybe that's the only report they get. So it looks at different conditions to determine what reports go to who. So if it's a specific level of management, they would get that report. If costs or revenues can only be controlled by specific employees, they'll get that report. And budget data often can be created or used for evaluating managers' performance. And we've made that comment before. So a little example, there might be a department manager that says, I'm responsible for controlling costs in my department only, so they would only get their report. There's the division manager, so they might look at multiple divisions. So maybe it's, electric cars at a company and there's 3. So they would look at all 3 electric cars. Maybe this department manager is only for one of the electric cars, or maybe just for engine builds or battery builds. Versus the president or CEO would be all of the company costs. So he would get that total upper report. When we talk about responsibility center, typically that talks about someone or an individual or a specific role who has control and is accountable for activities for that function. And it may extend to any level of management, just like the previous slide. It's very valuable in having this level of reports in what we call a decentralized company. So a decentralized company is one that has different parts of the operations in different locations. So maybe you do frame builds in Ohio, engine builds in Ontario, and maybe full assembly in Quebec. So you might have what's called a decentralized company. And also where control of operations is delegated to various managers in an organization, you'll have different responsibility centers associated with them. So accounting versus budgeting. So two differences typically exist. One is it helps distinguish between controllable and non-controllable costs. So the reports that go to a manager of a specific department, typically you want them to focus on what's controllable. What can they actually impact? So maybe it's the direct materials. If you are assigning them costs based on the space in the factory that you've assigned to them, they had no decision or no weight in deciding how much space they consumed, then maybe it's not really a controllable cost on them. That's kind of a corporate decision. So you would have them focus on the items that they can control. And this applies to both for-profit or not-for-profit companies. You have not-for-profit managers that are responsible for specific divisions or specific parts of the processes. Different goals. For-profit entities, you typically want to maximize net income, versus not-for-profit, you want to minimize the cost of providing services. So not-for-profit, you want to keep costs down. For-profit, they focus on just bottom line, sales less expenses. And we talked about controllable versus non-controllable. And typically, as you move down from the president down to division manager, fewer and fewer costs are controllable as you go down. And we've talked about this already. Performance evaluation, very often, you as a manager would be evaluated based on comparing actuals to budget. And that would be part of your compensation very often, or if they're going to keep you. Sometimes you manage based on exception. So you might look at a budget to actual reports, and you know what, you don't want to look through every single line item that has a favorable or unfavorable variance. So you typically set what we call materiality. So materiality talks about a specific threshold that unless it hits that threshold, you wouldn't even ask a question about it. So maybe it's a 5% variance on a budget, or 10% or greater than $2,000. It could be a dollar amount, could be a percent amount, but you set a limit, and anything under that limit, you would just skip at the time. And then you would look at how controllable is that expense by that manager. Can that manager have some input, 100% input, or none? So you may skip a line item accordingly. Because you have these responsibilities assigned to the various levels of management, you want them to have direct input into the process of building those budgets. We talked about this in chapter 15 a little bit, that the more inclusion you have from the different levels of management, the more ability, A, they can impact, and B, they have a vested interest to make sure that they hit those targets. Again, evaluation performance should be based on what's controllable. Upper management needs to support this evaluation process. Okay, so they can't just say so and not look at the reports accordingly. Management must have the ability to respond to their evaluation. So if I'm a boss of somebody and I say, hey, you're $2,000 over on this budget, what's going on? I need them as the manager, I need to give them the opportunity to respond and explain what's going on. And we should use the evaluation opportunities to identify both poor and good performance. So make sure you always talk to your employees about what they're doing well. Other principles, you want to, this is very repetitive, you want to only include data that's controllable. You want to provide accurate, reliable data. You want to highlight any significant differences. That talks about materiality. You want to look at that report and what you're providing to your manager, that it's intended for them and includes controllable costs and has been prepared at a reasonable time interval. And that's where we talked whether it's a weekly, monthly, quarterly report. You'll have a different report or set of reports for each level in the company's organization. We'll have a little picture in a minute. And it typically begins with the lowest level and moves upwards. And every higher level can obtain the detailed report at the lower level. So somebody at the top of the chain, so to speak, can get any report below them. But anybody below them, they typically only get their report or below, because it's about what they're responsible for. This little visual here, you might have a department manager in fabricating, assembling, and enameling. They'll see their departments. Versus a plant manager, they might see their entire plant, but every plant has fabricating, assembly, and enameling perhaps. So Detroit would see all three, but Detroit wouldn't see Chicago and St. Louis. Vice president, if they're vice president of a certain region or all enameling in all plants, they would see all of that. And then obviously the president would see it all, or could see it all. So a little example here. We've got the vice president of production. He sees his budget and actual costs for the different plants. And that rolls up to maybe the president, who sees all of the different VPs' budgets. So you can see how the link on the bottom chart, 1179, feeds into the production line of the president's report. This is where, for example, the president would get report A, but could ask for report B, just to see the details. Drop it down another layer, you have the VP of production, who has the different regions in the assembly plant. But at the plant manager in Chicago, it's broken down by department. So you can see how the 304,000 rolls up into Chicago, 304,000. And another level, Chicago is broken down by fabricating, enameling, and assembly. The fabricating department manager sees the breakdown between materials, labor, and overhead. So hopefully you could see over the last few slides how it builds into each other. So different uses of the system. Obviously, you can provide comparative evaluations, look at one manager over another, one department to another. You can rank different department managers and how are they effective in controlling various costs. And sometimes it can be part of their incentive or payment or compensation plan. So typically there are three different types of cost centers. You might just have a simple cost center, which could be production, enameling, finishing, things like that. And the basic cost center, I'll pause there. Cost centers, They incur costs, but they don't always necessarily generate revenue, which is why they're called cost centers. So managers have authority to incur costs based on what's assigned to their department. And usually production or service department, could be finishing, et cetera, like I mentioned. Then you might have profit centers. Profit centers typically look at revenues, so it's your sales teams. So managers are definitely judged based on the profitability of the center. So if they only have sales, you just look at the sales. But maybe they have sales and a sales team, so there's a gross profit number. So you focus on sales, sales cost, and maybe that gross profit. Could be individual departments or branch, bank branch offices, whatever that might be. Investment centers, they typically incur costs, but they also generate revenues. And they look at decisions over assets available for use. Investment centers might be, your facilities ownership arm. So whoever owns all your factory locations, they're typically considered investment centers. So a little graphic, you typically have cost centers that have expenses and it drives your net income down. Profit centers go both, and your investment centers go both ways. So a little review question then is, under responsibility accounting, the evaluation of a manager's performance is based on matters that the manager what? Directly controls, directly or indirectly controls, indirectly controls, or has shared responsibility for with another manager. And we always want to talk about that it's typically those that they directly control, because if they can't impact them, it doesn't make sense to manage their performance on it. So looking at responsibility accounting for cost center is we look at the manager's ability to meet budgeted goals for those controllable costs. So we look at the various cost center and said, what's their ability? We only include the controllable costs. However, there's no distinction between variable and fixed. So responsibility report, for an example, for this Fox company for the month of January, for the finishing department, we have our budget, which we have indirect materials, indirect labor, utilities, and supervision. We have an actual. And unfavorable, favorable, based on the different costs, favorable overall, $400 under budget. So this report then assumes that that finishing department manager is able to control all manufacturing overhead costs except depreciation, property taxes, and his own salary. The remaining 4,000, which is the 10 less the 6,000 of supervision costs, are assumed to apply to other supervisory personnel who that manager can control the salaries of. All this accounting is based on information available on controllable revenues and costs. The manager may control operating revenues earned, such as sales, but in this case did not. And the manager controls all variable costs incurred by the center because they vary with sales. So as they generate more sales, they might have more costs. They need to bring in salespersons more often. They need to have more office supplies because they're running more deals. So now we're moving on to direct and indirect fixed costs. So direct fixed costs is typically something that's specifically related to one responsibility center. So it's a direct cost to that one center. So therefore it's incurred for the sole benefit of that center. Another term that you may see from time to time is called a traceable cost because they can be traced to that one product or one center. And most direct fixed costs are controllable by the profit center manager. Indirect fixed costs typically pertain to a company's overall operating activities. It might be their overall facilities costs or their finance team costs, HR admin costs. And sometimes they're called common costs because they apply to more than one center and they're not controllable by that profit center manager. The responsibility report will include both budgeted and actual controllable revenues and costs, and there'll be some kind of cost, volume, profit, income statement. There'll then be a controllable margin, which is the excess of the contribution margin over the controllable fixed costs. So it's how much are they contributing to the company's bottom line. So a little example here is the Mantle Company, the responsibility report for the Marine Division for a year. We have total sales, unfavorable, unfortunately. We have our contribution margin after the variable costs, unfavorable 36. And then we have our controllable fixed costs. So they can control their cost of goods sold. They're selling admin. So their controllable margin is a $36,000 unfavorable. And this report does not show non-controllable fixed costs of 60,000. So we're assuming that there's other costs in this company's example of 60,000 because they cannot control those activities. So question then, in a responsibility report for a profit center, controllable fixed costs are deducted from the contribution margin to show the what? We just had it on the previous slide. Is the profit center margin, the controllable margin, the net income, or the income from operations? And remember, we're talking about what's controllable. So it's the controllable margin. So there's sales, variable costs, contribution margin, less controllable fixed costs is your controllable margin. And your non-controllable expenses will become your net income or net income before taxes. So let's look at an example again. We have this division, operates as a profit center, and it has the following information: sales, variable costs, controllable and non-controllable expenses, budget, and actual. And we're asked to prepare a responsibility report for the Midwest division. So remember, we had 1.5, 1.7, 7, 8, and 4 controllable. So we will ignore the non-controllable pieces. So preparing the responsibility report then, they're $200,000 higher in sales, but only $100,000 in variable, and fixed match budgets. Therefore, they're $100,000 favorable overall. Let's move on to learning objective 4. So we're looking at evaluating performance then for investment centers. So one of the primary ways to measure performance in an investment center is looking at the return on investment. So how well are they managing those assets to build a return for the organization? And it looks at what's controllable again by the manager of that investment center. So we look at the controllable margin divided by the average operating assets, and that'll determine an ROI, return on investment. Operating assets may include current assets and plant assets or capital assets used in the operations by that center and controlled by the manager of that specific investment center. Typically, non-operating assets such as empty factories or empty or idle plant assets or other land just held for future use are excluded. So if it's just items that are sitting around that aren't being functional or aren't being used, which is outside the control of that manager at this time, are excluded in this calculation. And the average operating assets look at the beginning and ending cost and book value. So very often you measure this on an annual basis. So you have to be careful that you understand the scope of the investment center's manager's responsibility. So are they responsible for all of the assets in Ontario or in a specific region? Is the investment center an independent entity for operating purposes? Are all fixed costs controllable? And it shows budgeted and actual ROI below the controllable margin. So let's look at a little example. So we've got this marine division and they sell stuff. They have variable costs, they have controllable costs, so they have a controllable margin. Their budget was a 15% return, 13.2% actual, unfavorable. So in this example, what if our average operating assets were 2 million in all cases, budget actual? So you take the controllable margin divided by the average operating assets is how we calculated these returns. So their actual return on investment compared to their budget is under by 1.8%. So looking at some factors that may weigh into a return on investment, we may look at the valuation of operating assets. So you may recall from previous chapters or courses that they may be valued based on acquisition costs, your book value, a fair value. So you need to make sure that you have a consistent valuation. That's all I would say on that. Each of those options do provide a reliable basis, but we have to consistently apply it between reporting periods. So that goes right back to accounting 1100 as around consistency or comparability to your competitors. What's your margin or income measure? So we look at controllable margin, income from operations, or net income. You may look at all of them, but again, you want a consistent item, and you also want to use an income measure that is part of the responsibility of that manager. So typically use a controllable margin like we did in the previous slide. Improving our ROI then can be done in different ways. We have this little example on screen. We have sales, variable costs, controllable fixed costs, controllable margin. So in this example, we have a controllable margin of 600,000 divided by an average operating assets of 5 million. So we have an ROI of 12%. Not too bad. So let's look at options. So he may be either increase sales or reduce variable and controllable fixed costs. So if our sales increase by 200,000 and our contribution margin increases by 90,000 because, go back, our variable costs are 55%, 1.1 million out of 2. So for 45% goes to our contribution margin. What if our controllable margin then increases by 90,000? So assuming all our controllable fixed costs did not change, our controllable margin went up by 90 And therefore our ROI went up to 13.8% instead of 12% because our average operating assets did not change. Another option is maybe they can reduce the variable and controllable fixed costs. So what if our total cost decreased by 140,000? Our controllable margin then increases to 740. It was 600. It's now 740 because we reduced our controllable fixed costs or our variable costs. So our ROI increased in this example up to 14.8%. Now let's assume that our average operating assets are reduced by 10%. So they went from 5 to 4.5 million. But our controllable margin remains unchanged at 600,000. So again, our ROI went up. So there are actually 3 different options on how we could possibly impact the ROI. Now remember, our average operating assets can only decline A, either we sell them off, or B, we amortize faster, which then affects your expenses. So just watch some of those assumptions. So a quick question then, in the review formula, sorry, for return on investment, the factors for controllable margin and operating assets are respectively what? Controllable margin percentage and total operating assets, controllable margin dollars and average operating assets, controllable margin dollars and total assets, or controllable margin percentage and average operating assets. So we know it includes average operating assets. So it's either B or C, and we don't want the percentage. We want dollars over dollars because it calculates a percentage. So in this case, it will be item B. All right, let's look at a performance evaluation for a division, the service division. We have sales of 400,000, variable costs, controllable fixed costs, and we have average operating assets told to us. And management is considering the following courses of action, independent course of action, in order to maximize the ROI. So that means they're separate potential decisions. One is we might reduce average operating assets by 80 with no change in controllable margin. Or 2, we might increase sales of 80 with no change in contribution margin percentage. So we need to first of all calculate what it is now. So we had $400,000 of sales, variable costs, etc. So what's our controllable margin and ROI right now? So 400,000 less the 320 is 80, less the controllable fixed cost is 39.2. 39.2. Oh, yeah, sorry. This is the expected return for alternative 1. 39.2 divided by the 280 current average, less the 80,000 as the option, will be a 19.6. Now in this case, alternative 2, our sales would go up by 80, but our variable costs would go up. So our new controllable margin would be 55.2. And for some reason, they didn't have a slide on the rate. So our controllable margin of 55.2 divided by 280, assuming no change in assets, would be 19.7%. So very comparable. So one option would be 19.6. This one here, 55.2 divided by no change in average operating assets would be 19.7%. So pretty much the same bottom line impact. All right, last little section is we're talking about the difference between ROI and residual income. So first of all, ROI as a recap is the controllable margin divided by the average operating assets. So in this example, 1 million divided by 5 million is 20%. The problem with ROI is that sometimes it ignores the minimum rate of return on the operating assets. So very often a company owns assets and has a minimum expected to say, hey, if I'm investing $1 million or $2 or 10 or $100 million in the plant, I want at least a 10% return, whatever that might be. So assuming a minimum rate of return of 10%, it should invest in Tracker because its ROI is 13%. So a little example here is if we, right now without this Tracker solution, we're getting 20%, but Tracker itself is getting 13, it'll drop us overall to 18, But if our minimum rate is 10, we should invest in Tracker, even though it drops our overall ROI, because it's still exceeding our expectations. So to evaluate the performance using minimum rate of return, they should use the residual income approach. So you look at the controllable margin less the minimum rate of return. In our example is 10% times the average operating assets, which means they have a positive residual income. If it has a positive residual income, which is greater than the minimum rate of return on our assets, then you should invest. So our contribution margin without Tracker, $1 million, plus the 260 is $1,260,000. Average operating assets, 10%. So our residual income is 500,000. That's any amount that exceeds our expected rate of return. Trackers are positive, so therefore our residual income increases. We should invest. Yes. And then what if we had two options, Tracker and CDOG, higher contribution margin on CDOG, but their average operating assets much higher on CDOG, so our residual income was the same. In this case, on the residual income basis, we should invest in both because they both have the same residual income and it's greater than our expected return. Now, the difference here is our average operating assets required to operate CDOG are much higher. We need $4 million in assets, 10% of 4 million is 400,000, versus we only need 2 million of assets to support Tracker. So a secondary decision might be, can we afford to invest or provide $4 million worth of assets to the CDOG line? One of the weaknesses. And that's it for chapter 16.